In our previous session, we discussed valuation of bonds and shares. Today, we are going to explore a new topic, and that is valuation of bonds. Bonds are a popular fixed income security offering predictable returns and, of course, acting as a vital tool for both corporate and government financing. Their valuation is essential for investors to assess whether the bond provides a fair return relative to its risk and market conditions. For issuers, accurate bond valuation is critical for setting competitive coupon rates and pricing. This subtopic delves into the methods used to determine the value of bonds, factoring in key elements such as coupon payments, maturity, market interest rates, and credit risk, providing a comprehensive understanding of how bonds are priced and their role in financial markets. So, what do you think are the factors that influence the value of bond? And how can investors evaluate whether a bond is worth its price when interest rates and market conditions constantly fluctuate? At the end of this topic, you will be able to define key terms related to bond valuation. You'll also be able to illustrate the process of calculating bond values. You'll be able to compare different types of bonds and their valuation methods. Before we start learning about the valuation of bonds, let us first understand what bonds are and why are they important. Bonds play a crucial role in the financial markets. Unlike stocks, which have fluctuating dividends and uncertain capital gains, bonds provide structure payments through fixed interest, coupon payments, and a predictable repayment of a principal. Bond serves as a bridge between borrowers and investors. Borrowers, like corporations or governments, issue bonds to fund projects, manage budgets, or refinance debt. Investors, on the other hand, see bonds on a reliable way to earn steady interest income while preserving the capital. This makes understanding how bonds are valued essential for anyone looking to manage their portfolio effectively or make decisions in corporate finance. In this session, we will explore how cash flows, interest rates, and time affect bond prices, equipping us with the tools to assess their worth effectively. To better understand about bonds, let us look at its key characteristics. First, negotiable promissory notes. Bonds are formal agreements where the issuer promises to pay interest at regular intervals and repay the principal at maturity. They can be traded in the market, making them negotiable instruments. Second, security and risk. Government bonds are generally considered the safest as they are backed by the government, whereas corporate bonds may be secured, backed by collateral, or unsecured, based on the issuer's creditworthiness. Another key feature is fixed interest rate. The rate of interest, also known as coupon rate, is typically fixed at the time of issuance. This provides predictable returns, making bonds a preferred choice for conservative investors. And lastly, redemption period. Bonds are redeemable after a specified period at which the principal amount is repaid. This duration, called the maturity period, can vary from a few years to several decades. Now that we understand what bonds are and their key features, let's explore the key concepts that are essential to value these instruments and assess their worth. First, face value. Face value is also known as par value. It is the principal amount the issuer promises to repay the bondholder at maturity. For example, a bond with a face value of rupees 1 lakh means the investor will receive 1 lakh at the end of the maturity period. Maturity period means the number of years after which face value becomes payable to the holder of the bond. Next, coupon rate. It is the specific interest rate on the bond. The interest is paid to the bond holder, which is calculated as par value multiplied by the coupon rate. Now that we understand the meaning of maturity and par value, it is easy to understand the concept of redemption value. Redemption value is the amount of the bond holder gets on maturity. A bond may be redeemed at par at a premium, that is when bondholder gets more than the par value of the bond, or at a discount, that is when a bondholder gets less than the par value of the bond. Market value. It is the price at which the bond is traded in the stock exchange. Market price is the price at which the bonds can be bought and sold, and this price may be different from par value and redemption value. Let us now discuss the types of bonds. Bonds are of three types. They are irredeemable bonds, redeemable bonds, and zero coupon bonds. We will now understand each of these in detail. First, irredeemable bonds, also known as perpetual bonds. These are bonds which will never mature. Indian Companies Act restricts the issue of such bonds. In case of these bonds, the terminal value or maturity value does not exist because they are not redeemable. The face value is known, and the interest received on such bonds is constant and received at regular intervals, and hence the interest received resembles perpetuity. The present value for such bonds is calculated by dividing the annual interest payable on the bond by the required rate of interest. Mathematically, it is represented as V naught is equals to I divided by small I t, where V naught is the present value, I is the annual interest payable on the bond, and I d is the required rate of interest. Let us take an example here. Suppose we have an irredeemable bond with a face value of rupees 1000, an annual interest rate of 5%, and a required yield of 4%. Here, the annual interest payment would be rupees 1000 into 5% is equals to rupees 50. Therefore, I is equals to, using the formula, the value of the irredeemable bond would be rupees 50 divided by 0.04. This gives us rupees 1250. So the value of this irredeemable bond would be rupees 1250. A redeemable bond is a fixed income security that comes with a predetermined maturity date. On this date, the issuer is obligated to repay the bondholder the principal amount along with any remaining interest. The repayment of the principal occurs on or before the specified maturity date. When such bonds have an option of being repaid before their maturity date, they are called callable bonds. A callable bond is a type of bond that provides the issuer of the bond with the right, but not the obligation, to redeem the bond before its maturity date. Redeemable bonds are of two types, one with annual interest payments and the other one with the semi-annual interest payments. Let us look at each of these two one by one. Let us now discuss bonds with the annual interest payments. To understand these bonds better, we will now look at this main characteristics. First, annual interest payments. This means the bond holder receives a fixed interest amount every year, calculated based on the bond's coupon rate and face value. Next, principal repayment. So at maturity, the bondholder will receive the face value or the principal amount of the bond in full. Lastly, the intrinsic value of the bond. To determine the intrinsic value in this case, the present value of all future cash flows, including both annual interest payments and the principal amount at maturity, are calculated. In the next slide, we will see how to calculate the intrinsic value of these bonds. The intrinsic value or present value of a bond is calculated by summing up two components. They are, first, the present value of annual interest payments, second, the present value of the principal repayment at maturity. Mathematically, it is expressed as V naught or P naught equals the annual interest divided by 1 plus K D raised to the power n plus F divided by 1 plus K D raised to the power n, where V naught or P naught is intrinsic value or present value of the bond, I represents annual interest payable, coupon rate into face value, F is principal amount, which is par value, repayable at the maturity, N is maturity period of the bond, D is required rate of return, which is discount rate. PVIFA stands for present value interest factor for an annuity, and PVIF means present value interest factor. Let's solve a bond valuation question to understand the concept better. Imagine we have a bond with a face value of 100 rupees. The bond has a coupon rate of 12%, meaning it pays 12% of its face value as interest every year. The bond will mature in 5 years, so the principal will be repaid at that time. Now the required rate of return or the discount rate is 10%. Based on this information, we have to calculate the value of the bond. Let's calculate the value of the bond step by step using the given information. First, we know the bond has a face value of 100 rupees. Second, the coupon rate is 12%, so the annual interest payment is 100 into 12% is equals to 12 rupees. The bond matures in 5 years, so n is equals to 5. The required rate of return or the discount rate is 10%. Now let's use the formula for bond valuation. V naught is equals to I into PVIFA KD, N, close the bracket, plus F into PVIF inside the bracket KD, N, close the bracket, where I is the annual interest payment, PVIFA inside the bracket KD, N, close the bracket, is the present value interest factor for an annuity, F is the principal repayment or face value, and finally PVIF inside the bracket KD, N, close the bracket, is the present value interest factor for a single repayment. Substituting the values into the formula, V naught is equals to 12 into PVIFA inside the bracket 10%, 5 years, close the bracket, plus 100 into PVIF inside the bracket 10%, 5 years, close the bracket. From the tables, PVIFA inside the bracket 10%, 5, close the bracket, is equals to 3.791. PVIF inside the bracket 10%, 5, close the bracket, is equals to 0.621. So the calculation becomes V naught is equals to 12 into 3.791 plus 100 into 0.621, which gives us intrinsic value of bond equals to 107.59 rupees. So the bond's intrinsic value is higher than its face value. Let's now explore bonds with semi-annual interest payments, a common practice in the real world. Unlike bonds with annual payments, semi-annual bonds pay interest twice a year. Because of the effect of compounding interest, the total value of these bonds tends to be higher than bonds with annual interest payments. To accurately value such bonds, we need to adjust the bond valuation formula to account for the semi-annual payments and compounding. Each payment is half of the annual coupon rate multiplied by the bond's face value. The required rate of return, which is KD, is divided by 2 to reflect the semi-annual period. The total number of compounding periods is doubled, which is 2n, to account for the twice a year payment. Now here's the formula for the intrinsic value for the price of a bond with the semi-annual interest payments. The value of the bond today inside the bracket denoted as V0 or P0 is equal to the sum of the present value of all semi-annual coupon payments, which is calculated by dividing the coupon payment, which is I, by 2 and discounting it for every semi-annual period by further dividing it by 1 plus required rate, which is KD, divided by 2 whole raised to the power n, plus the face value F, discounted over twice the number of periods at the semi-annual required rate of return. Let's solve a practical example to understand how to calculate the value of a bond with semi-annual interest payments. Here's the question. A bond with a face value of Rs 1000 has a coupon rate of 10% and a maturity period of 6 years. The bond pays interest semi-annually. If the required rate of return is 12%, calculate the value of bond. First, let's identify and organize the key details. First, face value, which is termed as F, is equals to Rs 1000. Second, annual coupon rate is equals to 10%. Therefore, semi-annual coupon payment 1 by 2 is equals to 10% into 1000 divided by 2 is equals to Rs 50. Third, maturity period, which is N, is equals to 6 years. Therefore, total semi-annual periods, which is 2n, is equals to 6 into 2, which is 12. Fourth, required rate of return, which is KD, is equals to 12%. Therefore, semi-annual required rate KD divided by 2 is equals to 12% divided by 2 is equals to 6% or 0.06. Now that we have gathered all the required values, let us put them in the formula and determine the intrinsic value of the bond. Substituting the values in the formula, we get V naught is equals to 100 divided by 2 divided by 1 plus 0.12 divided by 2 to the power 6 plus 1000 divided by inside the bracket 1 plus 0.12 divided by 2 to the power 6 is equals to 50 into PVIFA inside the bracket 6%, 12 years plus 1000 into PVIFA 6%, 12 years is equals to 50 into 8.384 plus 1000 into 0.497 is equals to 419.2 plus 497, which is rupees 916.20. In India, zero coupon bonds are alternatively known as deep discount bonds. These bonds become very popular in India for over a decade because of issuance of such bonds at regular intervals by IDBI and ICICI. Zero coupon bonds have no coupon rate, that is, there is no interest to be paid out. Instead, these bonds are issued at a discount to their face value, and the face value is the amount payable to the holder of the instrument on maturity. Thus, no interest or any other type of payment is available to the holder before maturity. Since there is no intermediate payment between the date of issue and the maturity date, these DDBs are also called zero coupon bonds. The valuation of DDBs is similar to the ordinary bonds valuation. Since DDB at the time of maturity generates only one future cash flow, the value of this may be taken as equal to the present value of the future cash flow discounted at the required rate of return of the investor for the number of years of the life of DDBs. The value of DDB is calculated as B naught is equals to F divided by 1 plus R raised to the power n. Here, B naught is the value of DDB or zero coupon bond. FV is the face value of DDB payable at maturity. R means the required rate of return and N refers to the life of DDB or the number of years to the maturity. Further, the effective interest earned on these bonds can be determined by simply calculating the difference between its discounted issue price and face value. Let us now solve an example of a zero coupon bond to calculate its realized yield. Here's the question. IDBI issued deep discount bonds in 2005 with a face value of 2 lakh rupees, a maturity period of 25 years. The bond was issued at 5,300 rupees. We need to calculate the realized yield of this zero coupon bond. Let's break down the details to understand the given question. Face value, which is F, is equals to rupees 2 lakhs. Issue price, which is P naught, is equals to rupees 5,300. Maturity period, which is N, is equals to 25 years. Substituting these values in the formula, we get 5,300 is equals to 2 lakh divided by 1 plus R raised to the power 25. Solving this equation, we get R is equals to 0.1563. Therefore, realized yield of this zero coupon bond is 15.63%. To sum up, in this session, we have learned bond-related terms like coupon rate, YTM, par value, and market price. We have also learned the calculation of bond values using present value techniques. We have learned different valuation methods for various bond types. That's all for today. Thank you and happy learning.